name of crypto. Because frankly, like, like if I come up with a FAF and just jump definitive ways of doing it, that's not how it works. If you go by the textbook definition, what we was taught in these schools, valuation is nothing but, like a net present value of all the free cash flow which a business generates in its all lifetime. So what will happen is that you'll invest in a company, it will start generating revenue. For some time, it will stay negative, and then you expect that it starts creating cash. And you as an investor will then start getting this cash. And there is a time value of money, and you'll think that this is the value of the company thus if I invest on it right now, and why then it should be a better investment compared to multiple other investment opportunity that you'll have. But however, if you look at any early stage company, it's very, very difficult to say how they are going to generate, like revenues in future, let alone how much it will be. So for example, if I take the example of Postman, when we invested in Postman, it was pretty much a Chrome extension. That was it. It was creating a community of developers. And we thought that it's a cool technology. There is something useful that can come out of it. So we put our seed money on that. If you told us whether we knew exactly how the ARR will be or exactly from where the revenue will come out from, we didn't have any clue of that. It was just a team bet. So the net point on this is that this entire thing of startup valuation is more of a predictive decision making than a definitive one. You try to take a bet and you think and you hope that that bet is right. However, that changes from stage to stage. That depends on many things, and we will try to cover some of it in the next slides. So generally, we tend to, in our mind, put any startup, if you are trying to evaluate it, into three broad categories. There will be seed stage startup, there will be a Series A, and then there is a post Series A. And that's because the shape in which these startups are, they vary very drastically based on what stage the company is. Seed stage will be just an idea stage. It's a pre-product team, it's a pre-revenue team. They are just a bunch of good guys who broadly understand a space and have identified a challenge in the space and trying to solve it. As a company moves from seed to Series A, what's expected is that you have put in some effort, you have created some product, and there are early signs of product market fit. So that if we put money in that stage to the company, that company can use the capital to grow itself fast and become a large company. As we go to the post Series A sort of a level, that's where the metrics and the growth numbers starts becoming important. And that's where actually a company's evaluation start becoming a little more scientific than just pure negotiation. So if I were to broadly classify at what stage, what is looked upon. So at seed stage, the most important thing is the founder and the team, why they are suited to solve a problem in the space that they have chosen. So I will sort of say that what becomes important here is that how do you story tell? How do you generate interest into a particular space? What is that deep insight, what Peter Thiel talks about, that contrarian question, which nobody is believing in, but you have a deep insight into it. How do you bring that forth and sort of pitch that in a very, very coherent way so that you can sell your vision? It's purely about selling your vision and creating a picture of what could be a potential outcome for the VC. Beyond that, it's all about estimation, negotiation, and cap table consideration. I'll also talk about how the public metrics and how the sentiments in the market is. That sort of helps you negotiate over here. But let's cover the Series A and the post Series A part after that. So as you move from the seed to a Series A, people will now start talking to you. If you already have some revenue, great. There is obviously a very high multiple at a Series A because of the growth numbers. You can start sort of think to ask for. But if you don't have that, the key things that's considered at the Series A level is the product. You would have done some initial pilots, POCs. There will be some NPS, there will be some customer feedbacks, and there will be some sort of sense how much is the customer, a typical customer, the TG that you're looking for, is ready to pay you in terms of annual contract values. Based on all these things put together, there will be some estimates, and again, it will come down to negotiations. There will be, of course, a discussion around, what is the sort of dilution you are ready to take. So you will have a discussion where you'll need that for the next stage, to take it to the next stage, I will need, let's say, $5 million. But I am thinking about only a dilution of 25%. And you will anchor the discussion around that. That would mean that I need a post-money valuation of 4x of that. That's like $20 million. So now you'll sort of start having those discussions around with the VC and try to see if you can create again storytell over here and then go to that level of fundraising. There, in absence of any sort of type of operational metrics, it will be very difficult to go into the numbers and discuss about that. However, in both the seed and Series A level, while the valuations are mostly negotiation, it has a significant impact from what's going on in the public markets or the sentiments. So let's assume that you are going for a technology which people know. So think about Postman again. We knew that APIs are going to be the few things in the future. Right now, if you look at how Postman has been valued, a lot of the valuation comes from A, the product and the growth they have created, but B, also in the fact that APIs as a space is supposed to be very, very lucrative. So people know what sort of multiple or what sort of revenues can get created out of it. They will back calculate from it and say that, hey, my cap table, now my infusion of this fund, where can it take? How much does it need to take it to a particular sort of an ARR if things are done well? So that's why how much exit can I get? So think about it like I take 20% of the cap table, giving it 5 million. And I think that the next round we can raise at a particular multiple, probably 50 million, I can raise at 200 million valuation. My dilution will be XYZ, and that will give me, and that I'm thinking, talking from the point of view of the VC, that will give me this sort of a stake and this sort of valuation. So that's how I will also value the Series A and C. So you have to get your story very right. So multiple companies which we work with and are taking from seed to Series A, we are thinking continuously about the product market fit as well as the space that they are working with. Is that a space that's macro wise will turn out to be good? Or do they have to tweak the product and think about problem statements which are much broader, wider, narrower, that sort of thinking? But the number games, and if you talk about the science in the valuation, that literally kicks in after the post Series A, where your key operational metrics, they start coming in. And the metrics are generally quite well known, which is like around the annual run rate, recurring revenues, growth rates, retention rates, NPS, pace. And obviously, when you do the numbers, generally some of these numbers have much higher weightage in your valuation. Like I would say the revenue run rate and recurring revenues and the growth rates have, at least recently in recent time, have had much more overweight on the valuation calculations than, let's say, the profitability or the NPS and the other numbers. Whether it should be that way or not, we will just touch upon that. However, I'll show that how the public markets have been behaving on that. So if you think about it, exactly what we talked about, like if you are a post Series A company, the operational metrics are the way to evaluate, and this has a bearing, as we talked about in your seed and Series A rounds as well, is that of the multiples. So you will have your key operating metrics. There will be some multiples which people will come at, mostly derived from the public market. There will be a haircut that people will put on it because public market multiples are generally larger than, higher than the private market multiples. And then they will put it on things like your annual run rate, things like your next 12 months run rate, those sort of numbers. So, and they will triangulate it by using some rule of thumbs. Like right now, the most popular one is the rule of 40, which is essentially your growth rate number plus your burn rate number. That's your EBITDA without the stockholders and others, such stuff that you pay for, not in cash. So if you put them together, how close are you to the number of 40? So let's take an example of this. So for example, if you talk about valuation of a Series A company, which is doing 100 million recurring revenue run rate at a growth rate of, let's say, 40%, at a net revenue retention rate, which essentially take care of your churn. So how many customers you have retained versus how many have upgraded versus how many have sort of churned out. you'll use a multiple of that. And the 10, if you see this example that I've taken over here, the 10 number here is a little arbitrary right now, because that's where in general public markets have tended. But you will take the market sentiment and find out that a company at your similar growth sort of a number, what is the public market multiple that people are giving? You will multiply it by your annual recurring revenue rate, multiply it by your growth rate, and then multiply it by net revenue retention. But however, this, if you see this formula, this completely disregards anything like profitability. And now people are realizing more and more that yes, you can put in a lot of money and sort of buy growth, but that does not create a sustainable good business. And in that case, you would want to figure out what the profitability number is. So what you'll do is that what people are doing now is you'll see, if you look at sustainable public market businesses, their growth rate plus the burn rate, if you put together, that generally tends to be around 40. So if you're, let's say, growing at 50% year on year, and your EBITDA is just minus 10% because you're growing very fast, then you'll put 50 plus minus 10, that is around 40, roughly around 40. If you're above 40, then you are great. That means that you are growing fast and you are profitable as well. But generally what will happen is that if you're growing super fast, your profitability will be low. But you are expected, like if your growth slows down, your profitability will increase. So if you are lower than 40, then is obviously there is something wrong and there is some haircut that has to be taken over there. So those are generally the rule of thumbs and sort of sensitivity analysis which people will do. Let's see how it's ending out when you look at the public markets right now. So, and this is interesting to see, because we have generally seen a very, very high increase in the valuations which the public market tech companies are getting, and rightly so. I would, some of the should be checked. If you can see right now on the right side chart, companies which have IPO'd post 2017, around 34 companies, they are trading at above 18x. Traditionally, this number has been anywhere close to like 7x, 6x was supposed to be high number for some time, but had stabilized around that 6, 7x. But this has gone up to 18x for some of these numbers, and that's where you hear the Snowflakes of the world or Zoom of the world, which very, very high multiples. What's this driven by is actually this expectation that the world is changing. Since the inception of cloud and what Salesforce did, more and more companies will move to cloud, and this cloud softwares will penetrate and grow even faster than what they are growing. So if you've seen further slide how Zoom has been growing at a more than 350% growth rate, people are expecting that sort of growth rate will hold, and that's why the multiple is more forward looking. And it's anybody's guess whether this will be this sort of multiple will hold or not.
Anand,
but however, what we were talking about, you'll see that generally the public.
Anand, sorry for interrupting.
Time to cover up for the time. Yeah.
Mm-hmm.
So great. So I don't know if Raghav, can you help me with if I covered this slide or which slide I was in? Or maybe
you were on the previous one.
Right. So this one is just to show how the valuations have, the multiples have gone up. So quickly to see that right now, if you look at all the companies that have IPO'd since 2017, SaaS companies, roughly around 34 of them, they are trading well above 18x, which is a very, very high number. If you see the overall average for the last few years, they tend to be around 7, 8, 9 is a very high number supposedly. But right now it's just going crazy, and rightly so, because the idea is that in future is all about cloud. People are moving to cloud, so there are companies like Snowflakes which are enabling that. There are companies like Zoom which is enabling remote working, or company like Twilio which is enabling communication. The valuations, these when they hit their IPO, the valuation have just been on the future growth perspective. But if you look at it, what we talked about earlier, in general, your private market valuations will be lower than public market valuation by a factor. Main reason being that the risk perception of a public market company will be much, much lower than that of a private company, right? Because you can, if you are an investor, you can liquidate in case something is going wrong, versus in your private market, like when we put in money, there's no way we can liquidate until and unless an exit event happens. So given all that, generally, if you look at the correlations, the public market multiples, private market multiples are like lower than the public market multiples by a factor of 2. Very rough number, no science, nothing. It's just a correlation empirically people have seen. So if you are evaluating yourself as an anchor point from where you should negotiate as a better or a lower, like whatever the negotiation goes, you should find a company which is roughly at around your growth rate and is in the public market and is in your space. You find out what sort of a multiple they are trading at. You subtract roughly, let's say 2 from that, and you take your trailing 12 months revenue and multiply that with that multiple and say that you are at that sort of a valuation. Now, of course, if your growth rate is high, you are more profitable, there is good market sentiment about the space that you are working in, your technology is better than what the public market companies in that space are, you should put a premium to that and try to negotiate at a higher valuation than that. That's broadly that. I have tried to chart out some of the numbers which is happening in the market right now. You can see that Zoom is trading at around 55x. I have not put Snowflake. Snowflake is more than 100x multiple. That's just crazy. But at the lower end, where your growth rates are very, very low, like FireEye and all this sort of companies, they are trending at 3x and all. So you get roughly the bracket at which the public markets are trending at. And you can think about, when you're valuing yourself, what brackets to look at apart from the previous one. However, if you look at the recent times, you'll see correlation. I've tried to draw it, the correlation with, and the highest correlation is R square of 0.52 is with the growth rate. So as we talked about earlier, and look at Zoom's growth rate, it's growing at, this one is showing 110%. It's well about around 300% quarter on quarter, not on year on year. And then if you look at Snowflake, look at the valuation they are at, because people know that the companies will need infrastructure, that data layer, and that is what Snowflake is enabling. However, if you look at the profitability, it doesn't seem people are factoring in profitability that much. The R square is actually only 0.02. So nothing to do with profitability. It's all about growth at this moment. Whether that's right or wrong, I don't know. Generally, I tend to put in profitability in mind, and that rule of 40, that's why it's very, very important. But as long as you are in the rule of 40 range, you should be good. So that's about it. But there are multiple other things. It should not always be about valuation. There is a quality of growth which is important. So there are multiple factors which go on into the valuation, at least in my mind. And that's where we ask our companies to always focus on that. So for example, the space, the quality of the team you are building, the moat. Do you become like in space, the technologies change very, very fast. So what is your moat and how are you innovating on that? That becomes very important. Quality of revenue, it should be more product driven revenue. Many a times you throw in services and sort of charge for that. That doesn't go too long. So that sort of growth is also not a very good growth. Churn, retention, gross margins, capital efficiency is one thing which, when COVID happened, it came into view a lot. Like last time in the recession, 2006 and 7, when there were companies which were hit very, very bad, their revenues went down. Unlike what's happening this time, it has been about adoption of software. Last time it was all about software revenues falling down. Capital efficiency, we saw that the companies which were capital efficient, like for every dollar of capital put in, they were getting more than that in terms of net revenue run rate, which is like a recurring run rate. So those companies came out the strongest out of that recession. So that is one thing we have focused even in this COVID time very, very highly, that the capital efficiency to growth should be managed. And obviously at the end of it, the LTV by CAC, if you are not to LTV of around 4x in a software or SaaS business, you should be thinking very, very hard on working on that. So that's pretty much about it. Happy to take any questions. I have put my email ID and Twitter handle over here. That's over there in my account as well. So I'm just going to read through the chat if some questions are coming through that. Okay.
Yeah, Anand, we've got a couple of questions. Let me just real quick list them out for you so it makes it easier. So the most recent question is from Abhi Anbergen, and he asks, how do you discount for risk in early stage ventures, seed or Series A? Another question.
Yeah.
Yeah,
So, yeah. Yeah. Let's. Okay. Uh, shall I take first and then go into the next questions? Yeah.
sure. It's up to you.
Uh,
It's your call. You can choose to answer any question you
yeah.
need.
Let's do that. Yeah. So yes, like that is the main. It's the art part, Abhi. Like seed and Series A is completely about risk, and that's where the multiples cannot be calculated way that you do for post Series A, where things have been taken care of. See, what are the things that we so there are multiple things at seed or the Series A level, right? There is space, there is team, there is the business model. Now we have a view on the space and we have a view on the team. That's what we pressure test the most at the time of seed level. And seed on Series A, the business model obviously sort of evolves between seed and Series A, or even the product that evolves. What you put the money at seed is completely about team and the space. And if we see that the risks is taken care of, that we value completely based on this sort of. So you'll see that this is the sort of entrepreneur in sales tech. What is the sort of multiple this sort of a company got there? That's how we will sort of value the seed stage company. At Series A, as I mentioned in the slides, some bit of the product starts coming up. You have some sort of feedback from the customers. So you are able to put in your mind whether this will be a product, this will be adopted by the customers or not. And that's where you start to think about the ACV. You start to think about that space, that if this company becomes like XYZ, which has evolved in this space, how will it look like? And then the risk that you want to then from there on, it's an execution risk which comes up, which gets valued at Series B sort of time. So there are a few risks that you cannot discount. And if you are asking me numerically how you discount, there is no science to it. There is no quantitative way of discounting that this will be 20% discount or 10% discount. We try to sort of map it to previous examples and go by those multiples over there. But unfortunately, there is no quantitative or numerical discount to it.
All right.
So that was for yeah. Yeah, go ahead.
That was a great response. Thanks for that. Abhi says thank you as well. So I think we have time for one more question. There's a couple of them that's dropped by on chat. So the most recent one from Raghu Bharat says bootstrapped, 4.5 million ARR, strong PMF, remote work domain. Any alternative financing options like SAFE? And then we've also got one from sorry.
No, sorry. He was talking about Facebook.
So that was the most recent question. And we've also got one from Surya Venkatachalam, where he's asking for seed stage, the magic number of Rule 40 are something that's hard to come up with in an arbitrary valuation. So is there an alternate way, like a default number, according to your thoughts?
Yeah. So I think that's partly got covered with what I was telling Abhi for Surya's question, that at seed stage, even during the slides I mentioned, right, at seed stage and Series A, the rule of 40 or the magic number, they do not work out because you do not have any ARR. So what will you derive the magic number with? So it's pretty much about qualitative. You find out like space, like entrepreneurs, what was the valuation they got, and then you negotiate from that, and it will depend on the market sentiment on the space and all about that. Happy to discuss it more in detail, Surya. Like just drop me a DM on my Twitter or something. But it's very qualitative. To Raghu's question on Bootstrap 4.5, by the way, congratulations on 4.5 million ARR. It's a very good number. It shows the strong PMF. Remote work is absolutely a hot segment. So do ping me out. All what you're talking about is sounds like making of a good company, Raghu. But what you should definitely focus on, I would like, obviously there are multiple complex ways, like there is safe note, there is debt also. The best way to fund your company is through your own profits, by the way. That does not help you dilute. But if you really need growth capital, these are numbers with which you should definitely hit the VC market, and then you should raise money from that. I wouldn't think at 4.5 million ARR in a space, you will be a valued company. There will be a lead investor who will value you. It will not, you do not, you, when do you do safe notes and others? When you do not know the value of your company, you say that, hey, I cannot value my company right now, or I'm going to hit a growth rate which will be something very, very different. And then you will try to go and, in the next round, you'll say, I'll give you equity at a certain discount. The numbers and everything you're showing, I don't think you need that. You should get valued at a very, very high premium. So obviously multiple other things like team and how much time it has required to go to that and competition, that will matter. But I would seriously ask you to go and meet some VCs. Do give me a buzz. I'm happy to talk. So.
And with that, Anand, I think we've arrived at the end of our session. Thank you so much for your time and for everybody that's attended today's session. For everybody that's here as an attendee, we'll make sure that you get a recording of the entire presentation along with a copy of the slide deck that Anand was presenting. Any questions, any doubts, you can use the networking panel on Hopin or just jump on to Sophia, and we're here to connect. Thanks again for your time so much, Anand. Have a great day.
Thank you so much, Raghav. Thanks for hosting. Bye-bye.
Bye, guys.